Thanks for tuning in to this episode of the Live at Lunch series on the Resilient Advisor Show. My name is Jay Coulter, and joining me today is Kevin Simpson of Capital Wealth Planning. Here on the Resilient Advisor Show, I like to bring you some of the industry's top thought leaders. I like to bring you investment ideas and portfolio strategy ideas, and that's what we're going to do today. We're going to have a conversation with Kevin Simpson about whether now is the time to look at covered call strategies and why. Kevin, let's start. Could you give listeners and viewers a little bit of your background?
Sure, Jay. Thanks for having me today, and what a great intro.
Right? You like the video? It's pretty fancy.
High tech. We started Capital Wealth Planning back in 2005, humble beginnings. There were three of us. And today our flagship strategy, the Enhanced Dividend Income Portfolio, has well over $2 billion in our strategy. Basically, it's a large cap dividend growth portfolio, and we tactically utilize covered calls to help buffer some of the downside to market fluctuation. The nice byproduct of that is a modest income stream that we pair with our dividends to help clients generate an equity income portfolio.
Excellent.
All right. How'd I sound there, Jay?
You know, the audio isn't great, but you know what I love? We knew the audio wouldn't be great, and you still wanted to move forward with this broadcast, Kevin. That's the kind of trooper you are.
You got to do the heavy lifting, my friend.
All right, Kevin, given that advisors are struggling to find income solutions for their pre-retiree clients and their clients that are in retirement, why is a covered call strategy something to look at implementing today?
Well, I think more than anything, we're in a zero or near zero interest rate environment. And according to what we'll hear from the Federal Reserve on Wednesday, we're expected to be in this low interest rate environment for the foreseeable future. That could be 3, 4, as many as 5 years. And it makes sense why the Fed would be actively keeping interest rates down, because if we think about what it would cost us to service the debt at higher interest rates, it's unfathomable. So if we're looking at zero interest rates or near zero interest rates, we need to find a way for individuals to generate an income stream. And if you think about the way Warren Buffett invests, or going back to Benjamin Graham and the Intelligent Investor, looking at high quality blue chip stocks that pay and increase dividends is a viable income alternative. And I would argue a terrific way to also keep pace with a little bit of inflation when we're talking about dividend growth.
So listeners, if you are watching this show on YouTube, Facebook, Twitter, LinkedIn Live, if you'd like to ask a question, simply type it in the comment section. If we use your question during the broadcast, my team will track you down and we'll send you a copy of my book, The Resilient Advisor. Kevin, let's begin with the end in mind. We're going to talk about your SMA and an ETF that you sub-advise that focuses on providing exposure to covered call strategies. Beginning with the end in mind, what's the difference at the end of the day if somebody were to choose to get exposure to a covered call strategy between using the SMA approach or an ETF?
Well, I think it comes down to investment dollars and how a financial advisor runs his or her practice. We focus on SMAs, and we feel like there's a tremendous advantage to transparency. So you work with a financial advisor, you hire a money manager. Every single month, you get a statement from your financial advisor. You see everything that you own in our portfolio. And more importantly, or as importantly, you get to see every transaction that we've made on your behalf. There's a little bit of a higher minimum to access a separately managed account. Our minimums are usually $250,000. And the reason for that isn't that we want to keep anyone out of the strategy, but when utilizing covered calls, you need a little bit more assets under management to be able to have round lots, or at least a good number of 100-share positions to take advantage of covered call writing. So the exchange-traded fund version, symbol DIVO, is a fantastic way for financial advisors to use us in a lower threshold or for financial advisors that don't use separately managed accounts but build their own portfolios. So I think that having access to us in two formats really opens up the ability for financial advisors to have more of a choice.
Yep, absolutely. And let's start with the SMA. So first, the enhanced dividend income portfolio is available at these firms, major broker dealers like Morgan Stanley, Raymond James, LPL, Baird, Wells Fargo. And they're available at a handful of other firms who are doing their due diligence on it as well right now. I'm sure I've been in the asset management business for a while. If your firm is not on this list, the story we're about to tell works for the ETF as well. So as we look at your process and how your team, and I want to keep this high level and encourage advisors to do some of their own due diligence, but walk listeners through the process of getting down to the securities that you put in the portfolio.
Sure. And full disclosure, I'm not certain that we're open and available on every platform that was up there. One or two are still in the due diligence phase, as you mentioned, but I'd say 90% of those are all good to go.
So that's the beauty of live broadcasting and having a third party go out and steal pitch decks to build out screens for this. So that one is on me if there's anybody on that list that is not currently active.
That's okay. If there's someone at Morgan Stanley clamoring to get us, we'll take all the help we can get. Everything else is good to go on that previous slide as I glance through it quickly. The premise of the portfolio is really total return. It's not a covered call strategy. We utilize covered calls as a component within it, but really what we're doing is we're buying and investing in great, high quality blue chip companies. So at its core, it's a fantastic blue chip portfolio, well diversified, completely rules based. Everything is driven by a process, metrics, fundamentals. Nothing has to do with how we feel or emotions. And we start with 25, typically 22 to 27 best of breed, high quality companies. And we select them for dividend growth. It's not a high dividend portfolio. We're not going to get stuck in the deep value trap. But we're looking for companies that have a great history of taking care of their shareholders by both paying dividends and increasing dividends over time. 5 of our stocks last quarter actually increased their dividends. In the wake of everything that's happening during this incredibly unusual year, 5 companies increasing dividends is something we're exceptionally proud of. Most of the names are going to come from the S&P 100. We can dip below into the S&P 500 if we need to, but 99% of the time you're going to see S&P 100 blue chip high quality stocks. We allocate amongst the 10 traditional sectors of the S&P 500. Even though that's not our broad universe, it gives you a rules-based process. We're not market timing. We're not sector weighting. We're not taking an exceptional conviction in any one stock. 5% maximum allocation to any one name. So good portfolio, well-diversified, dividend growth, 2.5% to 3% cumulative dividends. And then by tactically utilizing covered calls, we're going to generate another 2.5% to 4% a year so that we've got 5 to 7% cash flow on a high-quality blue chip portfolio.
Excellent. We already have some questions coming in from viewers. The first one comes from Rusty Russell, who on LinkedIn says, certain clients have values-based preferences either to screen out morally objectionable content or to increase impact for favored content. How tailorable is the SMA for those clients?
Well, Rusty, it's almost like we set that question up. We didn't, but thank you for it. Not only do we have a 5-star rated version of the SMA in its purest sense, we also offer a 5-star rated ESG version of our strategy where we utilize a filter for socially and morally conscious investing. And in fact, to take it one step further, we have a subset of that adheres specifically to Catholic social values. So we have our regular strategy, 5-star rated, and our ESG version, also 5-star rated. And for that subset, when it may be appropriate, we can even run it on a Catholic filter.
Excellent. Rusty, my team will track you down and send you a copy of my book, The Resilient Advisor, whether you want it or not. The next question comes from Vanya Papadilla. I apologize if I mispronounced that. She asks, what is the turnover of your SMA and current yield?
Sure. The turnover for the SMA, unlike the ETF, so there's some tax advantages, I would imagine, with the exchange-traded fund version. The turnover can be higher when we have strong surging up years, like 13, 17, and 19. Our turnover was much higher than a traditional buy and hold manager, because even to the extent that we did have covered calls written in those 3 big up years, there was some turnover. So I would say we're tax aware, but in those big years, we're not necessarily tax efficient. We also had 20+% total returns in each of those 3 years, so it wasn't the worst thing in the world. But just, again, educating clients and being very communicative with our advisors about what we can and can't do from a tax perspective is key to just good client education. We can harvest in the SMA if we should have a stock that's down at the end of the year. So we do have that customization that's always available for taxable accounts. From a yield perspective, we define it as cash flow. Again, it's 2 parts, 1 part dividend, second part covered calls. Generally, it's going to be between 5 and 7%. Until 2020, it had been running at about a 5.1% cash flow. This year, with heightened volatility, maybe the understatement of the day, Jay, we've written a lot more option premium, and the cash flow is annualizing out this year at over 6%. But again, that's a symptom of having more volatility in 2020 than we've seen for some time. Thank you for the question, Vanya.
Excellent. So let's look at the holdings as of the end of June. And I don't want to do a deep dive on what we see in here, but here's what stood out to me. You have 1 utility stock, 1 real estate, 1 in the materials sector. What is the selection process as it relates to picking the sectors that you're allocating to?
Well, again, it goes back to a rules-based process. We're going to have exposure to the 10 traditional sectors of the S&P 500. We're not required to have a real estate exposure, even though they did build that out as an 11th sector. We love Crown Castle as a 5G play. It's a stock that has tremendous dividend growth and is a cell tower REIT. So we're not in the traditional REIT space. But the philosophy behind this sector allocation is that, again, you're not having a manager that can get hot and lucky and then not be hot and lucky. So again, thank you for laughing. Not market timing, not sector overweighting or underweighting, and not having more than 5% with any one name. We use good old-fashioned, old-school rebalancing. We had Apple ran tremendously into the split. Post-split, it had gotten to be a 7 or 8% weighting in our portfolio. We trimmed it back to 5, so we locked in and realized a profit, a pretty attractive price considering what happened after that. We still own a 5% allocation to it, and we love the prospects of the company long term. But we've written a couple options on it as well. So having a rules-based process with the asset allocation and the selection is tremendously important. Equally, if not more important, is having a strict sell discipline.
Excellent. Let's talk performance for just a minute. And I encourage everybody to go pull up the performance of the SMAs and the ETFs on your own. But I just wanted to show you something new from my friends over at YCharts. It hasn't been launched yet, but they are going to start having SMA data available on the YCharts platform. This is going to be a game changer for financial advisors, who leverage SMAs. But more importantly, when you're in competitive situations now, if you're using the YChart platform, it's going to give you a robust tool in those competitive situations. Also pulled from a deck, the performance numbers of the SMA going back to 2013. Now, instead of asking you to walk us all the way through this, because the numbers speak for themselves, tell me, Kevin, where is this strategy going to come under duress? What's the market environment?
Well, I think there's 2 answers to that. One is the obvious. We're investing in the stock market. We're essentially 100% equity portfolio managers. So when you have a massive market decline, that risk is real. The neat thing about having a portfolio that uses more dividend growth, blue chip stocks, a little bit lower beta, and covered calls is that you're going to capture less of that downside when you have falling markets. And as was illustrated in the Y charts previously, although we can't diagnose all this that quickly with a glance, during the February 19th to March 23rd sell-off, we participated in about 75, 76% of that downside. So still, you're in the stock market. And if you can buffer it to the downside, I think that's tremendously important. So down markets are what are most problematic when you buy stocks. The counter argument against covered call writing traditionally has been, well, you forfeit your upside. You you don't make all the potential return. And I would submit to you that that's fine. Right on. We take profits along the way. We don't just hold things forever. We've sold Apple 4 times in the past 7 years. We just trimmed it back again recently. I would say that the best thing about being in a strong rising market, although we're not going to capture all of it, and it can work against covered call writing, is that from our tactical approach, we tend to write fewer calls when markets are rising and volatility is lower, and we tend to write more covered calls when markets are falling and volatility is higher.
Excellent. And I'm going to show some of those analytics, especially during periods of market duress here in just a minute. But let's pivot. I want to take a look at Devo, the ETF that you sub-advise from Amplify ETFs. Whenever I first go look at a particular ETF, I like to pull up my ETF action account. Here is some data that I thought was pretty interesting from there. We're able to see where the best ETF overlap is for Devo. What was interesting to me is I assumed ETFs like DVY would be in there. I actually had to manually add it. But as I look at the overlap, the highest overlap for this ETF is actually the Dow, DIA. It's 56% overlap. What do you make about that?
Well, I think it just comes back to the old-fashioned nature of what we look for. Show me great companies that have long staying power, increasing earnings, and take care of shareholders through dividends. Had a little change in the Dow recently, so we're probably not going to buy Salesforce, but it doesn't pay a dividend. So to me, the most natural fit is the Dow. Most people aren't old enough to remember it as the primary indice, but if you think of the concentration, again, I go back to Benjamin Graham teaching us that 30 stocks is plenty. More than that, you begin to over-diversify. So we look at that same type of high-quality concentration. So although I'm seeing that for the first time, it seems very reasonable to me.
Sometimes that's the tough part about coming on this broadcast live. I don't tell you what I'm going to put up on the screen.
I could always feign a system breakdown.
Ooh, yeah, that'd be good. Let's try it with this one. All right. Going back to wide charts, they have some great stress testing tools in there. So after I go to the ETF action site, check out an ETF, I throw it in wide charts and look at the drawdown during the coronavirus. This stress test looks really great for the ETF Devo. And to your point, Kevin, is it as simple as the covered call writing strategy help buffer the drawdown in that market?
I mean, that plays a part in it for sure. But at the same time, I mean, there's some alpha that we provide from the stock side. We owned Boeing heading into the coronavirus. I think I was on your broadcast before we really were talking coronavirus, but Boeing had been a position in the portfolio for many years with great success. Prior to a COVID-19 crisis, they were having some minor crises of their own having to do with the 737 MAX. So one of the things that we do is if we've got a stock that's underperforming relative to its peer group by about 15 to 20%, then we acknowledge that there's something company and stock specific there that may be problematic. So we'll walk away from the position. Doesn't mean that a stock down 15 or 20% is a sell. As you can see by the chart, and for any of us who remember the month of February, there was a lot of stocks that we own that were down well in excess of 15 to 20%. But when it's compared to its peer group, we'll figure out later what's wrong with it, but we don't want to be the person waiting to perpetuity. So we sold half the position on February 21st at $331. A week later, like March 5th, we sold the rest at $260. That was the maximum threshold for pain. Mm-hmm. About 3-4 weeks later, it traded under $100 and cut its dividend.
While I love stress testing ETF strategies and portfolios, really stress testing against the coronavirus experience kind of feels futile. I don't think we're going to experience that exact same scenario again or anything like it. But stress testing for periods of volatility does have a high amount of utility to it. And here you can see how the ETF held up during that March of 18 through January of 19 time period. And again, it held its own, was able to manage through the volatility. Some of the same reasons, do you think, Kevin?
Yes, it's identical in terms of how we manage it. So it's as much of a clone as you can get. We trade everything in there just as we do our SMAs. So the performance should be within a 98% accuracy or correlation. The one neat thing about Devo is you're getting a monthly distribution. So I know that it's been paying over 5%. Again, if we're thinking about a zero interest rate environment for the foreseeable future, if we can deliver something over 5% from a cash flow perspective that pays monthly, I would take a strong look at Devo. Again, it's not an apples to apples comparison to replace a CD. It's not insured, it's still stocks.
That's right.
But if you're thinking about, if you're a financial advisor and you're thinking about where we can get income that we can at least understand, this should be one of the top of the list.
That's right, which is a great reminder. I need to put my disclaimer in here, which is now scrolling across the bottom. But for podcast listeners, nothing on this show should be considered investment or tax advice. All right, Kevin, I pay attention to fund flows. Here from the ETF Action site, I'm able to pull up the fund flows for Devo. An absolute spike in the last 60 days in AUM in the ETF. What are your thoughts?
Well, I attribute it all to your podcast, Jay.
That's why I like having you on, Kevin.
Yeah, thanks. We should pay you a commission. Grateful. Of course, we don't pay commissions, but I'm grateful for the increased exposure for sure. And really, I think it boils down to people looking for income, the strategy in the ETF format now having over a 3-year track record, also getting a 5-star rating by Morningstar as it has with the SMA. So mostly this is indicative now of it just having a long enough lifespan that firms will take a look at it.
Yeah.
And your podcast.
And my podcast. So I'm going to go podcast 1.
Yes.
Live stream 2.
Absolutely.
Yeah. And then, of course, the space makes sense right now for folks that need some extra income.
Distant third.
All right. So what I'd like to do now is help financial advisors that have listened to Kevin explain the value proposition of using a covered call strategy in a portfolio and share with you why I think this could be applicable for for some client situations. First, as I look at this ETF, I noticed the Sorrentino ratio comes in really, really well at 0.68. That's my favorite metric when looking at either a portfolio or an ETF because it's showing us our risk reward parameters on the downside. If you look at the returns and the standard deviations exclusively, you'll see that the ETF Devo has enabled you to get higher returns with lower standard deviation off both the 1 and the 3-year period. What I have found from experience, the hardest thing to do with a new idea is to find a way to implement it. Again, this is not an investment recommendation, but here's a lens that I use when looking at a potential addition to a portfolio. In the example on your screen, Portfolio B is a simple 60-40 portfolio. That is 60% the Vanguard S&P 500 mutual fund, 40% the total bond market mutual fund. Portfolio A just makes a slight change to that by adding the Devo ETF with a 10% allocation. So 55% S&P 500, 35% total return bond, and 10% Devo. That's not a recommendation for an allocation, but you can look at the fundamentals of that type of portfolio. You're increasing your yield. You are only adding 4 basis points in that particular model of expense, and you're keeping your PE ratios and your price to sale and your book ratio in line. That's a really interesting way to look at the Devo ETF for a potential addition to a portfolio. Kevin, I appreciate you coming on this show. How could listeners find out more about you, your firm, Capital Wealth Planning, and the Devo ETF?
We have a website, capitalwealthplanning.com, and you could call our home office in Naples at 239-593-2100. Anyone, including myself, would be thrilled and happy to discuss either the SMA or the exchange traded fund, or just Jay behind the scenes. Anything we can share, 239-593-2100.
Excellent. Kevin, thank you so much for coming on the show again.
Thanks. I hope you can hear me at least a little bit, Jay.
We got it.